Good morning, or good afternoon. Sorry, I'm in a different time zone. Thank you very much for having me. As I was introduced, I'm a managing director at BlackRock, but more importantly, I'm responsible for LifePath investments globally. LifePath is the brand name for our series of target date funds, which I'm going to talk about today. I'm going to spend the first few minutes talking about pensions. That might be a bit repetitive, so I'll try to keep that to a minimum. And then I'll spend some time talking about target date funds and why they are, in my opinion anyway, a good solution as we move from the defined benefit world into the defined contribution world. And as a side note, because I go to a lot of countries and talk to a lot of people about target date funds, I'll make the observation that everyone is essentially struggling with the same challenge, right? So that was described in the opening remarks regarding demographics, rates of return on investments, and sort of preparation for that. So as the world moves from DB, defined benefits, into DC, a lot of people are looking at the experience in the United States. And in the United States, clearly target date funds have become extremely popular. So interesting statistic is that target date funds are about to reach $1 trillion in assets in the United States alone. Okay, thank you. So that's just to give you some sense of how big they are. I would also point out that for every new dollar going into DC plans in the United States, over 80% of it is going into target date funds. So it's essentially become the default investment in the United States for defined contribution plans. And so as a result, I think a lot of markets around the world are trying to mimic that. So once we get the slides up, I'll get going, or I'll just keep talking. So regarding the pension fund issue I was going to talk about, it's not going to come as a surprise to you. The data I have is primarily on the United States, not to be United States centric, but this is a lot of data. About 1/3 of all people in the United States have no retirement savings at all. So that's kind of a sad statistic, but what it points out is that retirement readiness is a challenge that is not really being addressed as well as it could be, I would say. It's not an indictment of the DC structure per se, it's that when we move from DB, where everything is taken care of for you, into the DC world, where you have to take care of it yourself, there has to come with some education, if you will, so that you can understand how much you need to be saving at every point in time to reach retirement success. So that's the first thing I would point out. I would also point out that demographically, as you well know, every person that's born today has a life expectancy that's longer than all of us sitting in this room. So if actuarial trends continue, a child being born today in a very long-lived country will have a life expectancy of over 100 years. So that's kind of amazing to consider. I think the other point I would make is that it seems improbable that you could work from age, say, 22 to age 65 and then have put away enough money to spend from age 65 to age 107, sort of equal time of working and retirement. So how do we fix this problem? So I'll just go through these. So as I was saying, the retirement crisis is essentially here. This is a bit of a repeat, I think, what you heard earlier, so I'm not going to spend a lot of time on this. But this essentially is showing you there's a lot of old people in the world, at least by percentage, and people aren't having babies fast enough, I think is the outcome here. I talked about these trends a bit already. I think probably the one that is most interesting and is persisted in the United States that we see, certainly in Japan and as well in Europe, is the returns on fixed income as a result of demographic changes. So the long end of the curve has been fabled to go up in the United States for a very long time. It has not, right? It still hovers around 3%. A lot of that is due to demographics. So for every person that's retiring, there's an insurance company somewhere trying to defease a liability, or somebody trying to get income from those assets. So that's holding down long-term rates, which perversely is making it more difficult to plan for retirement. There's some other issues here that we could talk about. Lack of easy access to pensions is another one. So making sure that people have access to, a system that they can save into so that they can consume from it. And last thing I would say is I mentioned a bit inadequate saving rates. If you look at these numbers here, and this graph is a little bit hard to read, but what it's basically saying is that this annual growth gap, or the growth of the gap, is the numbers below the triangles here. The dark numbers are the 2015 gap, and the light blue, highlighted there, is the 2050 gap. So, again, this may be a bit of a repeat to some of you, but it just shows you the challenge that we face, and that it's growing actually quite a bit. So even in a country that's relatively well organized, such as, say, Canada, I just got to see at the very end of Neil's presentation, talked about Canadian risk aversion, even they face a retirement gap or a pension gap of $13 trillion at 2050, not to mention places like Japan or the United States. I mentioned this statistic already. Now you get a cartoon to go with it. Basically what we're showing is that the distribution of retirement savings is actually not what you would like it to be, if I put it that way. And it's just very important in the United States because I'm not showing the statistic here, but as of right now, DC plans have surpassed DB plans in terms of total size. And so what this means is that all new money going in, so if you start work today, you're going to go into a DC plan if you go into any plan whatsoever. And so that really is the main place where you will consume from in retirement. And so these numbers right here are certainly not encouraging. So it's great to have a great system, and it's great to make great investments, but importantly, you have to save in order to consume later in your life. So this slide is a little bit non sequitur, but it came out of some work that we did as it relates to Latin America. And so what we tried to show is that actually that distribution of demographics is not quite as stark in Latin America because of the population growth. And so what we're trying to say is that you can reap a demographic dividend. That is to say, in the United States, right after World War II, we had the baby boom, and that essentially grew our GDP very effectively in real terms until, say, the mid-'70s. And so the idea here is that you could have a very similar dividend as a result. Now, it's very hard to read this graph. Hopefully you have it separately. But if you look at the bottom graph, what it says is that that's not going to last forever, right? So that sort of bottoms out around now-ish and then starts to reverse, and that demographic dividend starts to go away. So I guess the message here would be take advantage of it while you can. So, along these lines of reaping the demographic dividend, how would you go about doing that? And so we specify 5 key levers to help improve savings and investing. So first is the earnings and savings of women, right? So in the United States, there was a massive increase in women in the workforce, again, after World War II. And what that did is it grew GDP, because in many ways, for you economists, it's a function of productivity, but also labor force participation. So the idea here is that by promoting economic participation by women, you can increase GDP or GNP actually pretty significantly. I think consumption to savings is an important, I'd say, paradigm shift, in the sense that in the defined contribution view of the world, you are responsible for your own outcomes. And that's actually quite a bit of responsibility, but the point is you can no longer rely on a defined benefit pension plan to provide your income security. You have to save from your income. So that may be obvious, but that shift actually creates capital from which to run economic projects. So consumption to savings shift is actually an important paradigm shift. Next would be investment solutions. We clearly advocate for life cycle solutions, and I'll talk about those in a second. And then pension designs, right? So how DB and DC can coexist. And I would point out in Latin America, defined benefit contribution or defined benefit pension plans are actually much stronger, at least the benefits they provide, than in the United States currently. So when you want to have them side by side, meaning DB and DC, understanding how they relate to each other, the risks you can take in DC as a result is very important. And then lastly is capital markets, right? So we love capital markets in the United States. We have a very large capital market. It's very efficient. We advocate for that because it's a very efficient transfer of money through a system, through economic system. And it essentially allocates money to the most efficient projects in a naive way. But importantly, it allows for individuals to take advantage of economic growth in a very efficient way, right? And that's an important feature, I would say, of capital markets. And one that we take advantage of, obviously, when we create investment solutions. Okay, now I'm going to talk a little bit about target date funds. This is something I probably know more about than economics. So this graph is a little confusing. If I have a laser here, maybe I could try to... There we go. What this graph is trying to show or try to introduce is the concept of human capital. So for you labor economists, this is, kind of elementary, but for most people it's not. And the idea here is, as I described, you will make money in your lifetime. You need to save from that, right? This concept of creating capital from your income. You then need to invest it, I would selfishly say, in LifePath, right? If you're going to be in the United States or anywhere where we offer it. But, some sort of investment. And then ultimately you're going to spend from it. Right? And that is the self-saving problem from beginning to end, right? That is the life cycle consumption problem. But importantly, human capital is built up during your education years. So the very famous economist from the 1950s, Jacob Mincer, did the initial work on this. There was actually some controversy around it initially, but I think eventually everybody came to the conclusion, yes, it's actually strongly a function of education. It's strongly a function of industry. It's actually a function of on-the-job training as well. So education sort of continued into your career. And so it tends to peak around the time you get to graduating from college. Assuming most professionals do that. And even if you don't, it probably peaks around the time you exit high school or enter the workforce. And the idea is that that's your highest level of education. And it sort of sets your trajectory for how you're going to make money in your lifetime. So what is human capital? Human capital is the discounted value of all your future paychecks. So I know it's a little bit depressing to look at this because it's at its peak when you're young and you're essentially just losing as you work through your career. But if you think about it, that makes perfect sense because even if you're making more money every year, which most people typically are, you just have fewer paychecks ahead of you, right? That's the problem. So when you discount them, you get less money. It's pretty straightforward. But what's happening is that as you get to the point of retirement, somewhere around here, we show that you continue to have human capital in the sense that some people work in retirement, continue to do odd jobs, et cetera. But theoretically, your human capital then ends, right? You have no more income. And so if you follow this discounted paycheck idea, that's it. But hopefully, what you've been doing in the interim is you've been putting money away. You have been saving, right? You've been converting this income into capital. And then you've invested that money, right? And so the multiplication of your savings and your investment is what allows you to build capital over your lifetime. And so when you get to this point here in retirement, that's when the switch occurs. And that's when you no longer are taking in labor income to pay for your expenses. You're paying from your capital. And at that point, it becomes a question of how can you efficiently consume your capital, spend your money, however you want to put it, until you leave the planet, die. I've never come up with a good word for that, but basically when you pass away. Muerte. I mean, I just saw the movie Coco, so it's going to be relevant for those of you who know that movie. But yeah, so at some point here, we don't show the tail because it gets too depressing, but you pass away, right? And so balancing all of this out is the goal of a target date fund, right? That is what we're trying to achieve. We're trying to balance all of these variables that we don't know the answer to ahead of time as best we can. So to use the technical term, because I'm trained as an engineer, it's always fun, it's a multi-period stochastic optimization problem. So I know there's some people out there that feels good, sounds good. We solve what's called a Riccati equation, also cool. But it's essentially balancing all these unknowns out to get you to the best answer. I'm not going to spend a ton of time on this. This is essentially reiterating a lot of what I've said already. Maybe I'll spend a couple minutes. I think that most individuals have trouble understanding, first of all, the responsibility that's being placed onto them, right? It's a massive responsibility to make this investment for your income security. Moreover, they have no concept of how to make these investments. How do you diversify? Should you buy domestic? Should you buy foreign? Should you buy fixed income? Should you buy other things? What should you invest in? And so target date funds obviously do that for you. They manage risk, right? We understand what risks you should take at every point in your life. We also know that in that graph I showed you, you can take more risk here because on your personal balance sheet, you've got a lot of human capital. Although economists will call that non-tradable human capital, but it's there. And then later in your life, sorry, too many buttons, you don't, right? And so that's when you should take less risk. So in a very simplistic way, target date funds try to get the maximum return independent of risk early on or in light of that risk. And then later, they balance it very carefully to try to manage your risk in retirement. Good. So this is where it's going to sound more like a pitch, and I apologize for that because we use this slide actually when we talk to clients. But it's, I think, a good summary of all the things that matter. So I mentioned previously this concept of balancing out these unknown risks. So one is certainly life expectancy, right? You don't know how long you're going to live. And in fact, the uncertainty associated with life expectancy is probably the most difficult thing to manage in retirement as it relates to the investments and how much you should spend. Because if we all knew when we were going to die, muerte, I'm going to keep trying. You could just plan it out very carefully, right? You could set up a bond ladder or what do you want to do, take a little bit of risk, not take risk, diffuse your liability, and you're done. We don't know that, right? So DB benefits, or DB plans have the benefit of averaging across many individuals, right? So they have a good sense of what the distribution looks like, but any individual inside that distribution does not, right? You just don't know. So that's one of the sources of uncertainty. The other one is income. Now, I talked about how you make money in your lifetime being a function of education and industry and experience. It's still highly variable, and you can think about it from your own perspective, but how much money you make actually can vary quite a bit over your lifetime. I always make the joke that the only people that know exactly how much they're going to make in their lifetime is French government workers. I think it's all planned out ahead of time, and if they change that, there's a massive protest. Hopefully no French people here. Be safe. Anyway. But so everyone else faces uncertainty, right? So you don't know how much you're going to make. So, when you talk about diffusing your retirement liability, it's strongly a function of how much money you make, right? Because if you make, call it $100,000 a year your entire life, hopefully you've saved enough money so you can spend something close to $100,000 a year in retirement. That makes perfect sense, right? However, what if you made $200,000? Or what if you made $50,000? Then the amount you need to save in order to consume would be very different. But moreover, at the beginning of your career, you have no idea what it looks like, right? You could end up being the CEO of your company. You did a great job and it worked out and you made a lot of money. Or you end up somewhere middle management, or you get fired. A lot of things could happen, and that variability is also one of the things we consider. And then last but not least, market returns and volatility, right? Because the returns that you can achieve in the marketplace dictate a lot of how much you need to save. So as we tell people all the time and tell clients, if you lived in the United States from 1945 to 1975, and those were your working years, that's great. You had a great time. Great returns, fantastic. If you live in the modern era, where real returns at the 10-year are basically zero, now the Fed's increasing a bit, so we're getting close on the short end, you live in a very different environment. And so you need to compensate for that by saving more money. You essentially can't invest your way out of a savings problem is the tagline that we use. And so, again, going back to that, design issue, we're trying to balance out all these uncertainties simultaneously to get to the best answer. I'll leave it at that. So what does it look like? let me just say, first of all, this is kind of just indicative graph of what a glide path looks like. This is not intended to be anyone. It says Mexico here, but it's actually mislabeled, so apologies. But what it basically says is, at the beginning, you want to take on as much risk as possible, but not because risk is good, but it gets you the highest possible return. Now, it's traditional in DC space that you use long-only investments. In the United States, we actually use relatively vanilla index investments. So we essentially have a diversified equity portfolio, not surprisingly. Now, theory would tell you that if you could get a higher return than this at an even higher risk, that you would probably take it. So the question comes up frequently, well, would you ever put illiquid investments into a target date fund? And the answer is there's no reason not to, right, from theory, because you have a very long horizon over which to invest, right? At the age of 25, you've got 40 years roughly until you retire. And that's by today's standards. We know that number is going to move out, so maybe 45 years or longer. So you can give up liquidity. You don't need to have it. However, most DC systems don't allow for it because they want daily liquidity and daily trading. So that's a challenge. But things like risk parity, right? So taking on some amount of leverage to get a higher return for the same level of risk. Things like that would certainly be very reasonable to contemplate early on. And then, if you can remember, harken back to my graph a few slides ago, as your human capital starts to decrease, well, lo and behold, you should start to decrease your risk in your portfolio commensurately. And so that's kind of the basic story of accumulation for a target date fund. And then once you reach the point of retirement, right, there's no more income coming in, right? You're not going to take in any more paychecks. So at that point, you've switched over and you're just consuming from the money you've hopefully saved and invested. And that's when you're balancing out the risk of your longevity primarily, but also inflation risk. And then there's this idea of income volatility, right? So for a DB plan, there's no income volatility. You retire, you either get a flat payment or an inflation-adjusted payment. That's it for the rest of your life. It's done. For DC, it's the complete opposite. It's totally up to you, right, in a pure DC environment. And so I think it's sort of maybe, I won't say too far, but it's on the other side of the spectrum. And so I think that's where tools and information about what's optimal for consumption would be useful. Because we showed how capital should be declining in retirement. I think a lot of people don't understand they should be spending from their capital. And again, I know that sounds elementary, but many individuals don't spend from their capital. And so that reduces the amount that they can consume in retirement considerably. So anyway, balancing all those things out is very important in retirement. So this is going back a little bit to the policy issue. So what does an ideal system look like? So I'll just say a few words because I think a bit of this is repeat, but adequacy is important, right? You want to make sure that in the distribution of wealth and income that the left tail of the distribution is taken care of, right? That's a perfectly sensible thing to do and I think is represented in most societies. You should shoot for a 65% after-tax replacement rate. I mean, that's kind of a basic rule of thumb, but that should be something we shoot for. And that you allow some amount to be taken as an income stream, whether that's guaranteed or not. This number in the middle talks about sustainability of systems. I was recently in Brazil. If there are any Brazilians here, welcome. But they have a very generous pension system, and that's essentially at issue right now because it's great as a recipient, but it's very difficult to fund, obviously. And so the point we're trying to make here is that at least 70% of working age populations should be members of private pension plans. That's an aggressive goal for a lot of Latin America. But we think is useful to make sure that, it's paying for itself, if you will. Then we make some guidelines here about, funding ratios, et cetera. And then the last one is integrity. And we've heard from regulators today, and so that's very important, but making sure that there's a regulator overseeing this and that we're building a sustainable system. So we have some possible additional slides and charts. That's not a very strong closing, but I will say, hopefully I've given you a brief introduction as to why DC matters and why target date funds are a good solution for that. And I will leave it at that. Thank you for your time. I appreciate it.